Today we're going to talk about the market and has it broken out of its trading range, October and 7s, and keep your eyes on the bond market. I'm Paul Rickard and I'm mad about money. Hi and welcome to the program. Just me today, so let's get straight into it. 7 out of the last 8 sessions have been positive on the ASX. No way to read it, but we've clearly broken out of that trading range between about 5675 and 5825 that we're largely stuck in for the last 5 months. So some really positive sessions, really all about Wall Street dragging us higher. And of course, it hasn't been able to go down. So I guess the next stop is 6,000. Getting through 6,000 is going to be a very, very different proposition. We've bounced off there twice in the last 3 years. I guess we're going to need some really good news. So I don't think we're going to go through 6,000 in a hurry. We're going to need to see some really upbeat earnings statements, perhaps at the AGM, a lower Australian dollar, and moreover, further positive news out of the US and European markets. But we are going higher, and I guess for those of you who are long, just hang on a little bit. So that's the good news. Now, while we're talking about the stock market, how can you go past tomorrow and this week being the 30th anniversary of 1987, October 1987, the 19th of October 1987, the Dow Jones fell 23%. On the Tuesday, the 20th of October, we responded with about a 25% fall. Then, in October 97, we saw the Asian financial crisis, and in October 2007, we saw another stock market crash, the sort of the precursor to the GFC. So, lots of anniversaries, a lot of Octobers and 7s, and as we're moving in October 2017, lots of talk around the same sort of thing, well, the potential for the same sort of thing to happen again. Is it going to be different this time? Well, my betting at the moment is yes, because A, markets aren't quite as euphoric. Going back to October 87, the US market had gone up 40%, yes, 40% in the 10 months before it fell in October. The US market so far this year is up about 16%. PE multiples are a bit lower. Sure, leverage is a problem, but it's not so much in the companies, it's more at the household level. In Australia, we're still well below our high of October 2007, back about 6,800, so lots of room together. So look, take the anniversaries for what they are. They're worthwhile looking back in history, looking at the lessons, but do they apply to October 2017? I don't think so. However, as that's the bell, one thing you should be watching closely is the bond market, because our bond market's following the US bond market. It's obviously anticipating actions from the US Federal Reserve. If the bond market keeps going up, then that's the precursor to more interest rate increases, and that could cause some problems for both the US market and our market. Clearly, interest rate defensive stocks will come out of fashion, so things like some of the property trusts, some of the utilities, perhaps even companies like Sydney Airport and Transurban won't do so well. Interest rate sensitive stocks, those that will do better, things like the banks, well, they'll be well bought in the short term. So the bond market's the key to watching. Coming back to how all this links together, yes, we're going to 6,000. No, I don't think a crash is imminent, but probably the market to look at, keep the most attention to going forward is the US bond market. If bond rates in the US go up, keep on going up through 3%, then the world and the cycle could turn. I'm Paul Rickard, and I'm mad about money.